Hello and welcome back. This video is an introduction to stock picking. It is designed to familiarize you with the basic strategies of how to select stocks worthy of investing, and to assess stocks that you already do own. Stock market investing is fundamental to managing and growing your potential nest egg. The stock market experiences ups and downs. Hopefully this video will show you skills that will enable you to experience more ups and fewer downs. That is the idea. Like anything else, picking stocks is not about dart throwing. It is a disciplined, analytical process, but is not pure science. In fact, it is more art than science. There is no method that will yield 100% wins and no losing trades. However, if you use skills, select your stocks with thought and care, you can achieve a reasonable rate of return and maximize your chances of beating the overall market's performance. Again, there is no strategy or foolproof method to assure success. Not this nor any other tutorial will provide you that sort of Midas touch, per se. There are, however, strategies to improve your chances of success, and we will discuss those. First, let's discuss why this or any other tutorial will fail to assure your success. Primarily, that's because it is virtually impossible to develop a formula that will incorporate all of the myriad factors that can and do impact a company's marketplace success and its stock price variations. Not only are there a lot of variables, but also many of them are impossible to quantify. You can measure some things, but how do you quantify employees' skills and motivation, competitors' advantages and disadvantages, reputation among its customers, and etc.? These are just not measurable or quantifiable. Another thing is that stock price is determined by a marketplace made up of human beings that sometimes act rationally and sometimes do not. How do you, as an investor, anticipate and quantify other investors' emotions? How do you measure them? How do you quantify or predict fear? How many times have you just changed your own opinion based on human intuition? That's the sort of intangible factor that is at play in the stock market quite frequently. So these are but a few of the reasons that there is no single scientific model that can predict with assurance when and how an individual stock price will move. What we can do is apply some framework around how to think about a given stock in light of your personal investment strategy. Considerations such as how to incorporate into your investment strategy your personal tolerance of risk, your overall temperament, your time frame, and your time and interest level you have for managing your investments. Stock picking is a key determinant in your overall success, and yet it does require time and thoughtful decision making even still. None of us have a crystal ball. If we did, we would have long ago bought Apple Computer or Berkshire Hathaway or Microsoft and just ridden them into wealth long ago. We didn't, and that's why we're here trying to learn to sharpen our skills and improve our investing. Successful stock picking begins with research and analysis. We're going to beat this dead horse. The fundamental goal is determining and tracking a company's worth. Is it financially healthy? Is it well managed? Well positioned competitively? Does it have sales growth potential? Is it under or overvalued? And so forth. Successful companies require all these things and more. If you learn how to do fundamental value analysis, you are well on your way to successful stock picking. You may have read the financial press or heard on TV someone says a company has strong fundamentals. It's mentioned a lot, probably too much, but it is a solid place to begin your analysis for successful stock picking. This term merely refers to the fact that their analysis has led them to conclude that the company is well positioned for growth and may have inherent value greater than the price at which it is currently trading. Not everyone's analysis will come to the same projected value number or even the same conclusion relative to the current market price. That is because we all do analysis in our own way and come to our own conclusion of what it says to us. Thus, it leads us to make our own decisions and conclusions about a company's worth. While we all do our analysis, we're attempting to come to conclusions about the value of a company's future profits. There is a theory in this sort of financial analysis that recognizes the value of future profits must be discounted to get to today's value of future profits or cash flows. This analysis is called discounted cash flow. It is called discounted to recognize the time value of money, which realizes that $100 today is worth more than $100 in the future. Think of it this way. If someone says they'll give you $100 today and another person says they'll give you $100 2 years from now, which would you rather have? Most people would prefer $100 now so they can invest it and have more than $100 in 2 years' time. That is the time value of money. This is why we discount future cash flows. They are less certain than money in hand, and we don't have to wait. We may choose to employ those current dollars in an investment to make more money as we go forward. Considering future profits and cash flows is fundamental to determining what you think is the inherent value of the company. To do your own analysis, you make your own value judgments about what the company will/can accrue from future operations. You may be thinking this sounds all logical and rational, but if a company's value is the sum of the current value of its future cash flows, then why does a stock price exhibit such ups and downs? Is its inherent value oscillating like a roller coaster? No. A stock price is not just a best guess of future cash flows. It is also driven by speculation of future price swings. Some investors think more of traders who speculate they can successfully anticipate a price swing and sell for a profit without regard to fundamental value analysis. These traders look more to charts of trends and price swings than to fundamentals. This is the difference between technical traders and fundamental investors. There's no absolute answer as to which is better, fundamental investing versus technical trading. They both have their advantages and they both have their disadvantages. Generally speaking, stock picking via fundamental value analysis is a long-term investment strategy, and technical trading is a more short-term in-and-out strategy, perhaps for day traders. They totally follow technical forecasting and give little thought to fundamental value-based decision-making. For now, we're going to confine our discussion to fundamental value analysis. One of the shortcomings of value-based fundamental analysis investing is that it is time-consuming and rather difficult, but it is worth the effort in providing you insight and confidence. Company executives have difficulty forecasting sales, profits, and cash flows for the upcoming year, and yet value investors are attempting to predict and discount profits and cash flows over the next 10 or more years. Any number of events inside and outside the company can impact its success path and the investor's estimated value. So how does an investor reconcile the theory of discounted cash flow analysis with real-world reality and uncertainty? The process is to make reasonable assumptions to the company's future long-term cash flows, discount them to today's value, and come to an estimated value of future cash flows stated in today's dollars. The technical term for this is net present value. You'll see this. This is NPV. And this is the net present value of the estimated future cash flows. This NPV is investors' best estimate of the company's current intrinsic value, which is then compared to current value to assess the attractiveness of investing in that company. If the share price at which the stock is currently trading is less than the investor's estimate of intrinsic value per share, it is said the stock is trading below its real value or is undervalued, and the investor will likely decide to purchase the stock in anticipation of future growth. However, if the investor's analysis indicates the price at which it is currently trading is greater than the projected intrinsic value, the investor will not buy that stock. Instead, will look to alternative, better investment opportunities for now. Yes, this methodical approach requires time and care, but it yields a confidence in the merits of investing in this company for a long-term gain. As mentioned, this sort of analysis is called discounted cash flow analysis. It requires a set of complex calculations and is beyond the scope of this video, unfortunately. Basically, the investor makes a series of assumptions and then applies a variety of calculations to determine today's value of the company's expected future cash flows. In other words, what is the value of today's company's future cash flows? Is it more or less than the price at which it is trading today? Two of the assumptions that are considered in this situation are: 1. The time horizon. How long do you anticipate holding the stock? How many years do you feel you can reasonably project cash flows? And number 2, the company growth. What seems reasonable to project as a revenue, profit, and free cash flow growth rate? Is it greater, less, or about the same as the industry competitors? These assumptions can be used to project what the company's cash flow will be over the next few years. The key question is, what are these future cash flows worth today? For that, the analyst must consider another assumption, the discount rate. That is the rate at which the future cash flows will be discounted in order to restate them in today's dollars. There are a variety of sophisticated methods for determining an appropriate discount rate. Often, investors use the simple approach of using a rate that represents what they could earn if the money were placed in another similar investment rather than this one. Once the discounted cash flows are determined, they are incorporated into an overall value estimation of the company's total value. This is often referred to as the enterprise value. From this is deducted the company's debt, which yields the investor's best estimate of the shareholder's long-term equity value stated in today's dollars. The analysts then divide the long-term equity value by the shares outstanding to reveal a fair value for a share of the company's stock that reflects its future growth and cash flows. The investor compares this to the price at which the stock is actually trading to determine if the stock is under or overvalued. If undervalued, the stock represents a buying opportunity. Conversely, if the stock is overvalued, the investor will likely sell any shares owned and look to an alternative investment opportunity. This is a very general overview of the discounted cash flow analysis approach to provide you awareness of what it is and how it is used to assess the attractiveness of the company's stock and as an element of stock picking. Some investors strive to perform their own analysis, while others look to professional analysts to provide insight into whether the stock is under or overvalued as a part of their investment analysis and research. Regardless of the approach you pursue, understanding and incorporating this thought process into your stock picking and overall investment strategy will do nothing but yield benefit to you. We hope you found this stock picking video helpful and expanded your understanding of financial analysis. You too can invest knowledgeably. These videos are designed to help you build your investing knowledge and skills, develop and understand your personal investment goals, and develop a written plan in light of those goals. Use the knowledge you gain from these videos to help you choose investments carefully and prudently that serve your stated plan. Oh, and have fun doing it. Investing can provide a very satisfying way to control your own financial destiny. It is the ultimate interactive and instructive game. It can be a hobby or a lifelong passion. Enjoy the process.